Hello, everyone, and welcome back to this week's TradeFinder Live. It's great to be back with you all during this trading week and trading hours. Lots of exciting topics to discuss in this session. But first and foremost, we have to cover our disclosure disclaimer agreement, as we do for all of our live webinars or events. If you've attended any of those, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. Feel free to take a screenshot of that if you like. Other than that, for the second straight day, we've gotten weaker economic data, which seems to be creating some issues on the bond market. I look forward to hear what Rob's thoughts are on that. Of course, very excited to interact with you all. So at this moment in time, I'll introduce the man of the hour, Mr. Rob Roy.
Hey, Zach. Hey, everybody. Welcome to this week's TradeFinder Live. Just want to give everybody a heads up due to some scheduling conflicts. We are going to have a 45-minute session today, so the Q&A will start a little bit early, and we'll be finishing at 1:45. So have your questions ready towards the end. So I'll go quickly through all of the issues beforehand, and then we'll finish up, as I said, just a few minutes early. But let's take a look at the chart of the S&P. Just Dojiville going on here. The market is really unsure of where to go from here. For those that were thinking that we were off to the races after the 50 basis point rate cut, that has not been the case. One thing that I wanted to talk about, I didn't mention this in the U.S. market update. It was just omission. I meant to. I didn't know if anybody else got it. One person mentioned it in the commentary on the U.S. market update. But when Chairman Powell was talking about the 50 basis point rate cut, he also said that they are going to continue to reduce their balance sheet. That's a form of quantitative tightening. So he kind of slipped that in there, and it was almost really coy the way Powell was. He made the comment, and then he kind of paused and looked at the camera like, I wonder if anybody heard what I just said. So even though the 50 basis point rate cut would seem like, okay, that's a liquidity injection event, the fact that they're still reducing their balance sheet is a tightening. So in the end, the net is that it's not really a full quantitative easing event. And I think that's what those behind the scenes are struggling with, especially in the bond market. So we are still above the 10-day moving average and kind of just going through and consolidating where we'd gotten a little separation from the 10-day moving average. So from that standpoint, you can say, okay, the market is just really unsure of where we go. But you could make a bullish case that we're above this resistance area and consolidating there and could be ready to blast to the upside. And you would be hard-pressed to argue that scenario. However, when we go to the bond market, things look a little bit different. So if we look at the TNX, you can see that rates are moving up. Now, they're off the highs of the day. But then when we go to TLT, on the longer end, you can see that prices are coming down, meaning yields are going up. On the longer end, that may finally put a little bit of slowdown in the housing market. That's been much needed. We have talked about how with the TNX, we had looked at coming back to the breakout of the triangle that had existed right here. And maybe that's what we need to do out of the TNX, the 10-year. And we seem to be working in that same realm on the TLT, which we basically hit that point today and are trading around that area. So we are holding above the 50-day moving average. But it seems like the bond market is still telling us things are not right. The rate should not be going up when the Fed has announced a 50 basis point rate cut and the fact that they're going to continue to cut rates. The bond market is telling us the Fed is behind the curve. That's backed up with what Zach said about the fact that we've had weaker economic news. Yesterday, we had the PMI services report that came in weaker than expected. Today, we had consumer confidence, which was down quite a bit. We also had the Richmond Fed report that came out, and that was pretty negative, and it has been for a while, which tells you that certain areas of the country in the U.S., because I know we have international viewers, are doing better than others, or you could say some areas are doing worse than others. But the Richmond area, based on the Richmond Fed, is basically almost recessionary already. And so that comes back to the comments that I made in the U.S. market update from Jeffrey Gunlock, saying where he felt like in the months ahead, we'll look back to September as saying, hey, that's when we first started to see the signs of a recession. So he's looking more and more correct at this point in time, but it's early. It's only been a few days since the Fed announcement. We'll continue to monitor things and see where we go from there. But if you're a believer that the Fed's behind the curve and they're going to have to cut more aggressively, the bond market is like, we'll see it, we'll believe it when we see it type of thing. And the equities market is just like, what do we do from here? So still positive, consolidating above the triangle. So that part's okay. But where do we go from here is going to be the key there. So if we take a look at some of the other issues going on, I did want to bring up the dollar. Rick Santelli is really concerned about the dollar hanging in there so far, still at this 161.8% level. We have another area of support down at 99. If we do break below this, which he thinks we're going to, he knows more about the currency market than I do. But if we do break below that, 99 has to hold. If 99 doesn't hold, it's a Katie bar the door event on the dollar, which is not positive for anyone. Even the tech sector, which normally you have a weaker currency, and that's good for companies with international exposure from the exchange rate. But if we start to really lose the dollar, that creates a whole nother world of economic issues to deal with. Let's take a look at the VIX, which is still down in that range between 12.5 and 17.5. So there's no real volatility concern yet in the equities market. That kind of coincides with the fact that we're just drifting sideways above that area of what was resistance, and now we're testing it to see if it's going to hold as support on the ascending triangle in the SPY. If we take a look at the Dow, the Dow was one of our case study considerations here in TradeFinder. If you're following along with that, I did take it off of the social media platform in TradeFinder on the TradeFinder page within this software. And by the way, if you've been under a rock somewhere and haven't gone and gotten a copy of this software, go do it now. Go to hub.com. You get free Elliott Wave. You get free live intraday Elliott Wave. We also have, or the Hub organization also has a few spots left in the founders special for getting the AI signals. I think there's only 3 left. So if you want one, you need to do it now. You're grandfathered in for forever. So you got to take advantage of that now. They do follow through with their word. They won't be offering that same deal again. It's not like Black Friday specials is the analogy I always use, where everybody says, okay, Zach's telling me now that the founders is done. All right, so scratch that. But if you want the AI signals, I still think you should go there and take advantage of it. So that's already sold out. But when we look at the Dow, we did get up. I took it off before the Fed announcement because I honestly thought they were going to go 25 basis points and the market was going to be disappointed. I was wrong. They did go the 50 basis points. We still had a good result from that. But we got all the way up to right at our target price of 424, which is what we'd put in there. So if you held it a day longer than when I took it off, you actually hit the target. But it was still bullish. We've still been right on the Dow. That seems to be the place to be. And you can see that it's trending a little further away from the 10-day moving average. So a little overbought there on the Dow, not a whole lot, but a little bit more than the S&P. But not too much difference between the two markets. They're pretty similar, and that's how they usually work. They're not always the same or exact, but the two are usually pretty close together. Now, where we can get some separation is when we move into the Qs and the IWM. Now, we are trying to break above somehow, some way today. I don't really get what's going on in the Qs right now with the fact that interest rates are ticking up. but we are trying to break above this A wave extension, and that would be no harm, no foul. If we can break above this 61.8% level here, and that's where I think we need to go to feel comfortable that the Qs are going to extend on this C wave within the zigzag pattern. We've got to take out this A wave high. We're trying to do that today, but we aren't out at the close yet. Things can happen between now and the close, but getting above this 61.8% extension is key. If we can do that with follow through, then there you go. The Qs seem to be destined for that C wave extension. So kind of watching that really closely. Doesn't seem to be jiving with everything else that's going on. If we look at the IWM, backing off a little bit from that 225 area, as we've been talking about for the last few days. I did talk about this in the U.S. market update as well, that perhaps the new trading range is between 205 and 225. The IWM historically just loves 20-point trading ranges. We thought maybe it might be the 210 to 230, but we didn't go that far. So they kind of split the difference here in the old range between 190 and 210 and put 205 as the support and 225 as the high. But we are even with the IWM down to the 10-day moving average and holding above it so far. So even though it's not performing quite as well, still not performing poorly. Maybe the market needs to see some more continued weaker economic data, or maybe the market is saying, okay, well, if we continue to see this weaker economic data, the Fed has to cut more. But if we are going to get that recession, I think we're going to see some changes to the market moving forward. We'll take a look and keep you up to date on where things go from there. But let's take a look at the crypto world. We're hanging in there above 60,000. You can see right now we're trading at 63,396. So we went up near 65,000. The key is let's consolidate here under 65,000 and see if we can break above it. If we can, then we seem destined to go up and test 70,000 again, which the last time we were up there was mid to late August. And if we can break above that, things may be looking a whole lot better in crypto land. But 65,000 is the next key. We have to get above that area and move to that next level at 70,000. Looking at Ethereum, you can see that Ethereum is holding above 2,500. For those of you that are fans of Ethereum, I know a couple of you made mention of it in the U.S. market update. You're probably feeling a little bit of a sigh of relief, but we've got to take out this wave 4 high here. So we had mentioned, or I talked about, how getting above 2,500 was key. We needed to get this bullish cross back here between the 1030. We're trying to do that at this moment. And so holding above 2,500 would seem like we're going to march up towards 3,000. But we may have a little bit of resistance here at this previous wave 4, because technically we're still in a 5-wave to the downside pattern here on Ethereum. And even though the software is labeled the fact that this wave 4 is done, maybe it is, maybe it's not. If that is correct, then we may be running out of gas here on Ethereum and roll over. But if we continue to move higher, then perhaps we can disqualify this pattern. So there's still a little bit of uncertainty here. You're feeling a little bit better about being above 2,500, but again, it's not all signs clear. Everything is good to go. We're not there yet, but certainly better than where we've been over the last month or so, for sure, going all the way back to Yen Monday on Ethereum being problematic, as it seems. Let's take a look at the metals. If we take a look at the metals, they've just been a whole bunch of consolidating triangles here, and now they're taking off. So we had a symmetrical triangle, broke out, another symmetrical triangle, broke out, an ascending triangle, vertical breakout. Maybe we're getting to a point where gold may give us just a little bit of a pause. It needs to, because it's too vertical now above this 10-day moving average. So we want to see this calm down just a bit. So let's let the gold trade slow down and let the 10-day moving average catch up. The one that I think is really interesting that's breaking out big time today as well is silver. That's going to be our case study consideration for today, by the way, SLV. We do have a couple of really good looking AI symbols here. PWR is one that we've done in the past that worked out really well. Pretty excited about this one. So our alert subscribers at evotrader.com are going to get that this afternoon. But for now, what we're looking at, and that's just an idea of what you can get if you get the AI signals with this hub software. You can see we were just a little bit overbought, and we're consolidating today, which is exactly what I was hoping would happen to give us a little bit better entry to move in. But SLV will be the case study consideration for today, as I mentioned. Now let's go to natural gas, which also seems very interesting. Probably will do a speculative trade here. We've got yesterday the follow-through day on the break above 15, and we're consolidating today. Again, exactly what you want if you want to go long. So breaking above this area, and then of course we have another big hurricane in the Gulf. They think this one's going to be a big one. They're concerned about it. It's only a tropical depression now, but they feel like it's going to be a major hurricane within 2 days. The Gulf is extremely warm, and you get into the Gulf and it plays havoc with the oil rigs, etc. So we'll take a look at maybe a short-term trade in USO as well. But this consolidation here in natural gas seems enticing, and then USO just kind of meandering here. We'd like to see this break above the 30-day moving average with the 10-day, get that bullish cross. Oil is not really showing too much concern about the hurricane at this point in time. I've been mentioning over the last few of these live recordings that I've been doing that oil is just the one that who knows what direction we're going to go. Well, we may be getting a black swan event here with that hurricane, and that may turn things to where we actually head higher with oil. So I think those are two speculative plays right now that we can do. So just to give you an idea already, SLV is going to be our official case study consideration for TradeFinder this week. And I think natural gas and USO, and they kind of tie in with what you would expect when the Fed moves into an easing pattern. Maybe they're going to have to stop the reduction of their balance sheet because, again, it's a misnomer. If you get a chance, I don't know if you can go back and watch the recording of Powell's press conference, but watch what I was talking about. Watch when he made the comment about how they're going to continue to reduce their balance sheet, and the look on his face, and he looked right at the camera. And I was like, oh, yeah, I wonder how many people caught that. Now I know why they went 50 basis points, because this isn't a pure full-on easing. They're hedging, basically, is what that amounts to. So they're cutting 50 basis points, but they're hedging a full cut by still reducing their balance sheet. So they're easing and tightening at the same time. That's a hedge. So let's take a look at our current case study considerations that are left. I took a few of them off before we went into that Fed announcement. XLF, I still think that's going to be a good one. With the Fed easing, that should turn and move back to the upside. We are getting turned back down today, so it's feeling the effects of that economic data that Zach mentioned in the beginning, and we talked about with the fact that we're moving up in rates, down in prices with the weaker economic data. So maybe there's a little bit of a pause here. We do need to keep an eye on this. It's just right now we're having a little head bumping there against that A-wave high. But if we do get follow through to where tomorrow we close below the 10-day moving average again, I could change my tune on the XLF. That would mean the Fed's way behind, and the market doesn't believe they can play catch up enough with their easing. So that's something to keep an eye on. But for now, I think it's okay. KEY still hanging in there. We did make a new wave 5 high, but we haven't quite hit our target price yet. So we'll just keep monitoring this one and see if we can turn. Once again, trading below the 10-day moving average, so we'll keep an eye on it. We did take off Microsoft as a rare loser. We haven't had many of them. If you've been watching TradeFinder for a while, our case study consideration performance is stellar. I invite you to go back and look at the case study considerations that we've done in TradeFinder over the past few years. The record is pretty freaking amazing. But Microsoft was one of the few losers that we've had. So I went ahead and took that one off. But I also took off LYV, which was the one that we looked at just last week. And look at that move today. So hit our target, actually went above our target and still are. So if you've been following that one, you're cheering. You're pretty happy today. So I guess we're going to go to concerts. If we're going to have a weaker economy, Netflix got a downgrade. Maybe we're not going to stay home and watch Netflix in a recession. We're going to go to concerts, I guess. I don't know. But this one, I don't really get it. But hey, the AI called it. Another AI result, a 78% Q there, and it went up and hit its target. So that worked out extremely well. We're a little bit overbought now, so certainly time to take that one off, which I did this morning before we came on here. So that's a great one. That worked out extremely well. So we had big winners on the Dow. XLF is still in play. We had a loser on Microsoft, even though it started off great. I mean, we got pretty close to our target, just didn't quite get there. And then it reversed. We're going to hold XLF for now. I still think we keep the SPY as a hedge. If we do start to get weaker economic data and the fact that we're not breaking above that resistance area too significantly, we're consolidating. So we'll keep the SPY downward move as a hedge. We already had UNG that broke to the upside. That was a winner. And LYV was a winner. So what's that? 3 winners, 1 loser over the last 4. Not a bad record. We'll see if XLF turns out to be okay. And SPY, I just think, is smart from a hedging standpoint at this point in time. So just take a look at something that I did share yesterday with our subscriber folks at ewotrader.com. The INDA, which seemed to be maybe running out of steam based on the confirming indicators, just said, in the mortal words of Lee Corso, not so fast. Off we go again. We got way overbought yesterday, so we're pulling back a little bit today. We've got an amazing extension there on the wave 5 at 207. I still feel like it is starting to weaken. If this had relabeled to a wave 3, I'd think, okay, off's clear. The INDA is good to go for a while. But this is really getting extended. And let's take a look at the DMI. And even though it is giving a little bit of a move to the upside here, it's not at 20 yet. The negative directional indicator moving up, the positive moving down. We may not get the confirmation out of the DMI that we are ready to really move much higher. This could be a FOMO thing on the INDA. It clearly broke higher than I thought it was going to, but I'm not sure that it's full sail ahead on the INDA either. And I thought it would make sense to take a look at Germany. If we take a look at that market, seems destined to go up and hit that 61.8% extension, which is where you would think it would go after a B wave of 38.2%. We have all this information on our website at ewotrader.com, all the Elliott wave education on how we use it from a trader's approach in Elliott wave. It looks like 61.8 is in the cards for Germany, and if you're not aware of why it might be doing better over there, I've commented in jest numerous times, I have no idea what's going on in Germany. Well, what's going on? Hopefully you take the sarcasm away from the facts. They've been ahead of us in the Eurozone in cutting rates. So that's what's going on there. And then if we look down under in Australia, doing well, as you would imagine, because they're so heavily resource rich in Australia, so their market tends to move with resources. So you see gold and silver moving up. You're going to see the EWA moving up as well. So that's a quick rundown of what's going on. As I mentioned, we're going to have a shorter webinar today. So Zach, at this point in time, I'll take a few questions if we have any, and then at about 1:40, you can come in and show the people how to load SOV on as our case study, official case study consideration for today.
That sounds like a great plan to me, Rob. And yeah, as always, you predicted some that might be in the chat, as SLV is going to be our case study consideration that was requested there. So we're going to go over to DIS, Disney, for Trade Simple.
DIS, boy, kind of near and dear to my heart. Growing up 45 minutes away from Disney World and being one of the very first ones to attend Disney World. My parents took me there the very first week Disney World opened. So went across a wooden bridge across the Indian River to get to Orlando back in those days. Now they have the big high-rise things that you don't even have to have the bridge open. The big ships can go under. Anyway, I digress. But Disney, the Wave 4 is still active according to the algorithm. That's the Elliott wave algorithm, which is programmed exactly as Elliott wrote it in this hub software. It's not a personal adaptation like some of the other Elliott wave softwares are out there. Holding above the 50-day moving average. The streaming, interestingly enough, is what's carrying the ball, which has been the exact opposite in the past. In fact, when we were coming down here, on the move down, the concern was the streaming side of things, the lack of new content, just the lack of new subscriptions. It wasn't doing well. The theme parks were doing okay. And then now we've turned and we've completely flipped the script where with potential recession, there's concern about how the theme parks are going to do, but the streaming's doing better. And we look here, we see a really nice zigzag, but look where we are. We are already at the exact 100% extension on the zigzag. And with that wave 4 still not confirming that that move is done, we could move a little higher. Let's see what the DMI is showing to see if we get an extended. We're rolling over a little bit on the ADX. So what we would need, at least what I would need to continue to trade Disney higher from here is I would like to see the ADX turn back up to give us some sort of confidence that we're going to go up to that 161.8% extension. Since we've already hit the 100%, this zigzag is complete. So I just want to make sure we're clear on that. When you get a 61.8% B wave correction, you look for a 100% extension. It's exactly what happened. That's why I love these zigzags. But now we're in a little bit more doubt. The algorithm's not sure if this wave 4 is going to hold, so perhaps that would give it room to go up to the extension. I want to see the ADX turn back up, so I'm not too comfortable with where that is. And we're still in a qualified 5-wave to the downside pattern. So this could have just simply been a complex wave 4, and then we roll over and move back down. That's still a possibility with Disney. So Disney's a hard call right now on where we would go from here. But if you're wanting to trade it, if you're long, I don't see a reason to get out right now. We're still above the 10-day moving average. We're still above the 50-day moving average. We had a recent bullish cross. We're just hitting our head against that 100% C wave extension. We could very well move up to the 161.8. But 95 is the key. I don't think I would add a long now. So if you're long now, I would stay long. If you're looking to go long, I'd wait and let it break 95 first. I would want to see a break above that area and then enter for the move up to 100. If you're looking to short it, then what you would want to see is a break below this A wave impulse here. So when we take a look at the current price there, just above 90, you would want to see a breakdown below that. I'd be a little more nervous about shorting it at this point in time since we are above the 10, 30, and 50-day moving averages. Just not super confident about the long at this point either. But really interesting chart to look at. Thanks for asking about that one. And while we get ready for the next question, I just want to let everybody know that we are doing tomorrow night. We have one of the other gurus at ewotrader.com is going to do a presentation called Earnings Alchemy. It's around how you can trade earnings, how you can look for explosive moves on earnings. He has a very cool system. He's been trading longer than me, which there aren't too many people around that have been. I used to run a hedge fund, Jeff Beamer, and he's going to show you how to look for explosive moves around earnings or how to take advantage of IV rushes into earnings where the stock is likely not to move, and you capture the IV crush following earnings. So it's called Earnings Alchemy. Please join us tomorrow night. It's at 8 p.m. Eastern Time. Zach, I believe, will put the link in to the chat here so you can sign up if you haven't already. It's free. Love to have you join us. So all things earnings we'll be talking about tomorrow night with Jeff Beamer, who has some really well-proven systems around both sides of trading earnings. All right, Zach, I'm sorry, wanted to get that in there. So next question, if we've got another
Yeah, no
one.
worries. I'm very excited for that event. We'll go over to Manuel for two symbols here. First one, TTD.
Yeah, I haven't looked at Trade Desk in a while, so we'll see how it's looking. And no 5-wave pattern currently, which is interesting, but we do have a zigzag, I think. Let's see if it qualifies. It looks like it probably would. So the high of the A wave, not really. We just came down to the 50-day moving average. I really want to see that B wave come down to 30%. Basically, we're right in the range of the 23.6% level, which I'm not a big fan of, and nor was Mr. Elliott either. So the best you would look for on an extension is the 61.8. But once again, this kind of goes back to the whole Disney thing. If you're long this, I don't see a reason to get out. We are above the 10-day moving average. We're consolidating what was a slightly overbought condition a few days ago. We have separation between the 10 and the 30. We're above the 50-day moving average. The DMI here looks a little more constructive than it did on Disney. So that kind of gives you the appearance that, the likelihood of going up to that 61.8% level is there. Wouldn't look to short this one with this pattern at all. In fact, if you aren't long and are looking to go long, I think you could take a shot on this one as long as we stay above this A wave level here. So that would be your stop. If you wanted to initiate a new long position, your stop would be if we broke below that A wave high. And if you are long, I don't see any reason to get out. So what was the second symbol, Zach?
Second symbol is going to be AFRM.
Oh, and we haven't looked at a firm in a while either. This is kind of a throwback show. Zach, we're looking at some stuff that we used to look at a lot. And another one that, go ahead.
No, I was just saying a little blast from the past.
Yeah. So we do have the positive directional indicator below the ADX, but it's still above 40. And that's still showing some strength. This gap up, as you know, I don't like that. A little concerned about that move there. So it looks to me like we have a complex wrong thing here. Want to get the zigzag. Looks like we still have a zigzag pattern in play and a complex one, I would say as well. So the 38.2% B wave correction would send you up to 61.8. This is kind of performing a little better than the rest of the financial world right now. A little surprising because we heard from Ally Financial during that financial summit that they were seeing some issues with consumer paying their bills, but it doesn't seem like a firm is having that problem. They seem to be holding in there, and we're just kind of consolidating here at the 38.2% extension, right at that A wave high. So once again, if you're long, I don't see any reason to get out. It seems likely in a decent market that we continue up to the 61.8% level. And in this case, if you were looking to short, once again, don't know that I would short it yet. We are trading at this moment, as you can see below that A wave impulse. But as long as we're above the 10-day moving average, I think you stay the course. But if you're long and you break below the 10-day moving average, I think that could be your stop. And if you're looking to go short, a break below the 10-day moving average could get interesting as we still have this big gap back here that we had a little bit of a retracement but didn't get filled. So I think keep an eye there and see what happens on that B wave retracement. But kind of bucking the trend there, AFRM is, from what you might expect if you heard that commentary from Ally Financial a week or so ago.
Yes, indeed. All right. And I see we're at 138, so perhaps maybe one more symbol before heading over to the platform to post the idea.
Sure. Sounds good.
All righty. For ERV85, can you check out Meta, META?
That's a good one to finish on, Zach, because the whole world seems to be talking about Meta. We've replaced NVIDIA with Meta. Everybody's talking about it. As you can see, movement to the upside here. Even though the AI wasn't too convinced, it gave it a rating here, but wasn't that sure that we were going to make it. I think this kind of shows you the power of the AI. Even the ones that it doesn't feel confident in still went up and hit their target. I think that's pretty darn impressive. We like to see a rating of 75 on the AI, and it was at roughly 30%, and yet we still got within a hair of hitting the exact AI target price there. But this has been the theme of this show today. Is stocks that if you're long, you don't get out yet, not time to short them. If you're entering a new position, I would be a little nervous about that, even though looking down here at the DMI, it still looks constructive. I don't like the fact that the negative directional indicator is ticking up so much today. So we're just having one pullback day, and it seems like the sellers are seizing on that. Now, that could backfire on them, right? I mean, it's not worked yet. Every time the sellers have tried to come in, Meta has turned and had another run. So you can see that we had this big run here, really nice zigzag there, and then we made a new high. They tried to sell into it again. We formed a triangle, took off, had the breakout, went to that AI target. And so if you are long, I would stay long. And I would look at that wave 3 high, which coincides exactly with the 10-day moving average. We break below that, then I think you need to get out. If you're looking for an entry, I think you'd have to see a break above this previous wave 5 and maybe another consolidation day or two, gather some energy, break above that level there, and then that means probably we're headed to 600. I think that would be the next price target, but I'd want to see it break this previous wave 5 high first. So kind of a lot of we need to see more. It's the Missouri show, Zach. Show me. All these charts that we're looking at, every one of them needs to prove something to enter a position, long or short. So with that, thanks again to everyone for watching during market hours. And Zach, if you want to show them how to post SLV, we're going to use upside target of 30 and a half is going to be our, well, actually, we're going to make it 30. We're going to break that wave 5, but we're not going to go all the way to the 100% extension. So we'll leave us a little bit of room. 100% extension on the zigzags at 30 and a half. So we'll just call it a little bit shorter than that. So about $1 move out of SLV. So it's taken a little bit of our shine away today. That was what I had on the list for today. And when you know it, it's already making a big upward move, but nonetheless, not too bad. So All right, Zach, I'll shut up so you can show the folks how to post.
No worries at all. Yeah, let's head over to the platform here. I can see you have my screen there. So we'll go over to the ideas button there, the toggle on the right side toolbar. This one is going to be an idea, right? An official idea, not a post there.
Correct. This will be an official idea.
Just real quickly, some of you have likely heard this, but for those that have not, a post is like a draft idea. When you post an idea, it's essentially the same thing as if you were executing a paper trade. So everything that is taking place for the trade, all the data is real time and exactly what would be happening if you actually were risking capital, but it's just paper trading. And so you won't be losing any money. However, if you feel there's some criteria you still need to see fulfilled for it to be an official idea, you can create it as a post for reference once that criteria is met. So we'll go to create an idea. This one is going to be on SLV. And then we'll search here in the symbol, SLV. We'll see that first one there. Rob said we're going for a target price of 30. And the time frame on that one, Rob?
Show them the custom 2 months because I don't think it's going to take 3 months to get there.
Yeah, it's a good idea. And so as Rob was saying, there's the different intervals here, fixed amounts of time rather that you can choose from. But if you need something more specific, you can go down to the very exact specific trading day that you would like. Rob said 2 months, so we're going to go 2 months from here. And I always like to go to the next trading day. So today is what, the 24th? And so that would be the 25th Monday of November. So this will be a lot prettier and more detailed very soon. I'm just going to go ahead and actually post this idea now. So as you might be following along on the platform with us during this webinar, you'll see it is now published. You can go in and interact. We encourage you to interact, vote, agree, disagree, comment any of your thoughts on there. We love to see the interaction. And we also welcoming opposing opinions as well. I think I've said this before as an echo of what Rob says, that opposing opinions are what makes markets. Because if everyone was thinking the same thing, then there would be no trade. There always has to be a buyer and a seller. So on that note, I will pass back over to you, Rob. It was a great session.
Yeah, I think so too. And the stocks again that we looked at were some that were, as you mentioned, blasts from the past, but also a lot of commentary on looking for where stops are and where targets are, where entry and exits are. So we had a lot of that comprised into the Q&A today. And that's what I love about TradeFinder. So thanks for joining us, and tell your friends. It's a great community. Let's get them all part of it. Having discussions and furthering Zach's comment that opposing views is what makes markets. And as long as we have respectful differing of opinions, it makes for a really good show. And it's helpful and educational for everyone when it plays out that way. So thanks again for taking some of your trading day out with us. And if you haven't, sign up for that Earnings Alchemy show tomorrow night. I think you're going to find it really, really interesting. And if you've ever wondered, how can I play earnings? Stocks move around earnings, or sometimes I think stocks are going to move and they don't. How can I play it? You'll learn how to do it tomorrow night. So love to have you join us for that. Look forward to talking to you again soon. Take care, everybody.